All right, picking up where we left off. So, once again, if you think about the example that I just said regarding what a purchase money security interest is, it's simply a special form of security interest that occurs in consumer goods. And what ends up happening is there's automatic attachment as soon as a deal is made, and then it's perfected if the person that's taking on the loan takes possession of the collateral that they're actually buying. So this is important because if somebody else comes in and wants money in that collateral and sues the debtor for it, it's the actual store or Walmart in this case that will take automatic priority and win in that scenario. So let's look at this example. So on January 2nd, bank lent debtor $50,000 and took a security interest in debtor's currently owned and after acquired equipment. On June 2nd, EquipCore sold debtor equipment on credit and took a PMSI in the equipment. On June 19th, Equip perfected the PMSI. Equip has priority over bank. So let's break this down a little bit. So here you have in January, the debtor takes out a loan with the bank, and the bank now has a security interest in the collateral used for this $50,000 loan, which is debtor's current equipment and equipment that the debtor later gets. Correct? So in June, the debtor ends up taking another loan out with EquipCore, but he took a PMSI. And he took a PMSI because he's taking possession of that equipment immediately for taking the equipment on credit before he pays Equip back. So because he holds it for 20 days, it says here that in the rule that EquipCore now has perfected their security interest in that equipment. And even though the bank had a security interest in all of debtors after acquired equipment, Equip still has priority over the bank and can still get that money back for that piece of equipment purchased on June 2nd before the bank can. And this is because it was done through a purchase money security interest. So when a creditor or secured party enters into a secured transaction, what are their rights and what are their duties? So when the secured party is possessing a collateral, waiting for a debtor to pay them back, they have to use reasonable care at all times to preserve that collateral. They have to keep the collateral identifiable, and they bear the cost of reasonable expenses, particularly as it relates to preservation, use, or custody of the collateral. Pretty self-explanatory. So they have three options if the debtor actually defaults and doesn't pay them back. They can sue the debtor immediately for how much they owe, and this would be called reducing the claim to a judgment for deficiency. Secondly, they can peaceably try to take possession and sell the collateral and keep all the proceeds for themselves, or they just keep the collateral. That's it. So this is pretty self-explanatory and the crux of why we learned about secure transactions in the first place. What happens in the event of a default? So let's say the secured party decides to employ the second option of peaceably taking possession and disposing of the collateral. Well, we call this proceeds of collection or enforcement. And once the collateral is sold, what ends up happening is it's paid out in order. And I'll go in order. The first people to be paid out are the reasonable expenses to whoever is, conducting the auction. Maybe it could be attorney's fees. Second, the debt that's owed to the secured party that has the interest in the collateral gets the money that they are owed. Then whoever is a secured party in the collateral but is subordinate, meaning they didn't have priority, then gets their money back, and then any additional money goes back to the debtor. So the disposition, or the sale in this case, has to be commercially reasonable. And if, let's say, the sale doesn't cover how much the debtor owes, then the debtor owes the difference of insufficiency and is liable for that amount of deficiency. So that covers secured transactions. So next, let's switch gears and take a look at bankruptcy administration. So what is bankruptcy? So bankruptcy is something that the federal government allows as a legal mechanism for individuals and entities to declare something called bankruptcy and then be able to pay off the people that they owe, and they start from scratch. They don't owe anything after they declare bankruptcy. So the U.S. Constitution, Article 1, gives Congress the exclusive power to establish, quote, uniform laws on the subject of bankruptcies throughout the United States, end quote. So this is all enshrined in a federal statute called Bankruptcy Reform Act of 1978. And the objective of the statute is to ensure that the debtor assets are fairly distributed to creditors and the debtor is given a fresh start. So there's two types of bankruptcy that are each broken down into voluntary or involuntary bankruptcy. So we have Chapter 7 liquidation, both voluntary or involuntary, and then we have Chapter 11 reorganization, also either voluntary or involuntary. So for Chapter 7 liquidation, the eligible people or entities are individuals, including couples, partnerships, and corporations. Ineligible would be municipalities, railroads, insurers, banks, credit unions, and other types of S&Ls. For Chapter 11 reorganization, the only eligible people are persons that are eligible under Chapter 7 or railroads. For ineligible would be shareholders, commodities and stockbrokers, and also insurers, banks, credit unions, and S&Ls. So just remember that insurers, banks, credit unions, and S&Ls, they're all ineligible for either type of bankruptcy under the U.S. Code. So, a Chapter 7 liquidation, what happens? Well, it converts a debtor's non-exempt assets to cash distributed in conformity with the code. And an honest debtor then is discharged from remaining debts and given a fresh start. Eligible parties are most debtors, including individuals, partnerships, and corporations. Pretty self-explanatory. Pretty much the government comes in and converts every asset that is non-exempt, and there's a category of assets that are exempt, and then sells it all, turns it into cash, and then distributed according to all of the legal protections. So what about Chapter 11 reorganization? So this is when partnerships, corporations, railroads, and debtors are reorganized. Their assets are reorganized, in which there's a restructuring of their finances. And in the case of a company doing this, the business ends up continuing, not getting dissolved. Whereas in Chapter 7, it pretty much is dissolved. And then the creditors are paid from this reorganization. So this is our brief overview of bankruptcy administration. And thank you all for attending this winter session course. I hope you all learned a lot. Feel free to reach out to me for any issue. And yeah, hopefully if you find that this class was conducted according to your expectation, leave me a good review. Thank you so much, and hopefully we'll have another class together.